Hey everyone! Today we are talking about mortgage forbearance, what it is, and why you should care about it even if you don't have a mortgage. So why should anyone other than homeowners care about this? Because we're all connected. We're going to go down a little rabbit hole here, but stay with me. At the beginning of March, 0.25% of loans nationwide were in forbearance. That number is now up to nearly 6%. That equates to roughly 3 million homeowners. Now remember, there's no such thing as free money. Investors have the money. Mortgages are funded by investors. When your loan goes into forbearance, the servicer still has to pay the investors every month. They have a contract. Now, of course, lenders understand that people are going to default on their loans. Life happens. Sometimes you get a scratch on the car. And that's why we have mortgage insurance and interest to help offset those costs. In fact, lenders are required to maintain a certain amount of capital to cover those rare occurrences. Unfortunately, there is simply not enough money for the entire country to go into forbearance. So the FHFA sees that forbearances are skyrocketing and recently changed the policy a little bit. Now servicers will only need to advance those monthly mortgage payments to investors for 4 months once a borrower has entered forbearance. This helps the servicers a little bit because it lets them know exactly how long they will have to advance payments. But remember, borrowers can ask for forbearance up to 12 months, which brings us to our first problem. And this affects everyone who wants to buy a home in the foreseeable future. Who is paying the investors for the remaining 8 months? Are they just expected to take a loss? So, now we have a problem because investors are no longer buying mortgage-backed securities. They're too risky. Investors want to know that they're going to get their money back. So, how do you entice investors to overlook this greater risk and still loan out their money? You enforce stricter lending guidelines and raise the interest rates. This somewhat minimizes the risk and makes the potential profit worth it. Well, this is really bad news for that first-time home buyer, for that single-income family, for that lifelong renter who is just about to take that first step into home ownership and building wealth for their families. Now they can't afford to buy a home because the interest rates are too high. The debt-to-income ratios are off. Let me explain. The average sale price in Orlando is $250,000. In the Conway area, 3-bedroom, 1-bathroom homes built in the 1950s with about 1,000 square feet and some renovations to make them move-in ready are selling for about $200,000. You may be able to find a 3.2 around $180 that will pass inspections and qualify for an FHA or VA loan, but that's going to be tough in Orlando. And finding something less than $150 is almost impossible. So that first-time home buyer who was pre-approved up to $150,000, their purchasing ability has now decreased to $135,000. They're out of the market. That buyer who was approved up to $200,000, they're now down to $180,000. They're going to have to make some compromises, and they have fewer home options. Our second problem. What happens when too many loans go into forbearance and the servicers can't advance funds to their investors? They run out of cash, they go out of business. The servicers that are most at risk and are hurting the most from these forbearances are non-bank mortgage firms like Quicken and Freedom Mortgage, for example. Non-bank lenders are responsible for 86% of the FHA, VA, and USDA loans. These are your first-time home buyer, lower credit score requirement, little to no down payment loans. These loans are awesome products for borrowers who are just entering into homeownership and starting to build wealth for themselves and their family. Unfortunately, if these non-bank lenders go out of business, that means potential homebuyers will have less options when applying for mortgages. Less options means some buyers may not be able to get financing. each lender only has so much money that they can lend out. And when you have the option of doing a higher risk loan or a lower risk loan, you're probably going to go with the lower risk. So you see, we're all connected in this. What you do matters. If you still believe that forbearance is the right choice for your circumstances, please be sure to have an in-depth conversation with your mortgage company about the repayment terms and get everything in writing. If you were just wanting a forbearance because the option was there to skip a few payments, I beg you to reconsider that choice. Let's leave that for the folks who truly, truly need it. Because remember, the lenders only have so much money, and there's no such thing as free money. I'm Rebecca Daniels with Homes with Bekah. If you have questions about real estate or you need help buying or selling a home, be sure to give me a call. As always, stay safe, stay healthy, and make it a great day.